Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is John McCoach, president of the TSX Venture Exchange. He's speaking to us from Vancouver. John, welcome to This Week in Money.
Thanks, Jim. Pleasure to be here and appreciate the interest in TSX Venture Exchange.
The Venture Exchange recently did a number of town hall meetings. Where were the town halls and how were they received?
We had about a dozen town hall meetings across Canada. Of course, we had town hall meetings in the 4 major cities that we have operations, Vancouver, Calgary, Montreal, and Toronto. But we also went to places like Halifax, Kelowna, Winnipeg, Regina, Saskatoon, etc. So we really got great feedback from literally coast to coast in Canada, and I think they were received very well. There was, each one was a little different. There was the Vancouver Town Hall had about a dozen or 8 people that were quite concerned and raised a number of issues. But for the most part, I'd say the dialogue was constructive and we got some good ideas. So I'm very pleased that we did them. We wanted to hear all points of view. And, what I took from that was the people care. Like, if they felt passionately about this market because it's so important, not only to the people that are directly involved in it, but to Canada. And I'm so glad that people came out and had constructive ideas, but also to hear the passion from the people that were concerned and are challenging us to do other things.
In your March 2016 progress report, the town halls were asked, do you believe short selling has a material negative impact on the market? 57% responded yes, reintroduce the Uptick rule. Well, let's talk about the Uptick rule. We've been doing a series called Killing Canada's Junior Markets, where structural problems in the junior markets have been discussed, along with other issues. The Uptick rule is at the top of the list. Do you agree with the respondents that the Uptick rule should be reinstated, and are there a number of options available to reinstate it?
Well, if I may, first of all, with all due respect, Jim, I think that's a terrible name for a series, but I would much rather we all focused on how we can revitalize, rebuild, and reclaim the strength in the junior capital markets in Canada, which is something that I think we should all be very proud of and want to see succeed. So I prefer to focus on the positives, but I'll address your specific question about the Uptick rule.
Right.
I personally think an Uptick rule is appropriate for a junior market. It's an appropriate check and balance for companies that have less liquidity typically, although the liquidity has been improving recently quite a bit, and where stocks can be a little more volatile. So I think an Uptick rule is a good feature of a market, particularly a venture market.
Are there ways to reinstate it?
It's difficult. It's possible, but it's very difficult.
Which regulator has the power to reinstate the Uptick rule, and are you lobbying them on behalf of listed companies and shareholders?
Well, the Uptick rule, or a tick rule, used to be, was repealed in 2012. In fact, actually, it wasn't an Uptick rule at the time it was repealed. It just couldn't sell short on a downtick at that time, but those rules came under the Uniform Market Integrity Rules, which are enforced by the Investment Industry Regulatory Association of Canada, IROC. And yes, we've been having conversations with IROC. We've had a number of conversations with IROC. IROC's very interested in finding a solution, but as I said, there is no easy solution for this one.
If the Uptick rule is not reinstated and the junior resource stocks are in a bull market for a couple of years, could easy money be made by continually shorting the stocks on the downtick all the way down? And would the selling momentum resemble a pump and dump?
I think there's a couple of different issues in there. First of all, in a bull market, I think or let me rephrase, if in a bear market, an uptick or the lack of an uptick rule could have more of a negative impact because you've got general momentum pushing the market down and selling on a downtick to speculate that the stock's going to continue down just exacerbates that. In a bull market, obviously you can put pressure on a stock, but if the momentum of the market is upwards, it becomes far more risky to be selling short. So I don't think that has really anything to do with pump and dump, and I think that or that concept of pump and dump, and I think that the market is much more susceptible to problem trading in a downtick or with a downtick in a bear market.
There are 13 trading platforms for the TSX Venture stocks in Canada, including the TSX Venture Exchange. Is it true 90% of trading in the venture stocks is done through the Venture Exchange and the remaining 10% done through the other 12 platforms?
April 21st, we traded 88% of the trading on the venture stocks happened on the Venture Exchange. So it's close to 90%. It varies anywhere from the high 80s to 90% typically over the last few years. Now, that doesn't mean that the balance of the 10% is equally spread over the other alternative trading systems that are in Canada, but in theory it could be.
Could the uptick rule be reinstated to work on each of the 13 platforms separately?
I think that's when I mentioned that it'd be challenging to reinstate an uptick rule. That is one of the challenges, because each marketplace would first of all have to agree. Not that the marketplaces necessarily dictate if IROC can or the securities commissions can implement trading rules, and the marketplaces have to abide by those. But when you've got a fractured market system, it becomes difficult to determine what actually the last trade was, because when you're trading in trades happen in milliseconds, it becomes a technology challenge to look at all those markets to actually see what the last trade was.
The regulators are said to have opened the markets to additional trading platforms to avoid the ongoing monopoly of the TSX. Now, 12 platforms are responsible for 10% of the trading, while the TSX Venture is responsible for 90%. And the end result of this is a market without an uptick rule. For the greater good of the market, could the venture be open to negotiating deals to end the participation of other platforms trading TSX Venture stocks, thereby resulting in a single trading platform where the uptick rule could easily be reinstated?
Well, first of all, Jim, I wouldn't say that the multiple marketplace is a global phenomenon. This is not just in Canada. So in the United States and Europe have many more markets than Canada has, actually. And so this is just a part of the evolution of capital markets generally, that there are multiple marketplaces in there for trading. So and I also would say the repeal of the uptick rule in 2012, or the tick test in 2012, was not necessarily directly related to the creation of or the evolution of multiple markets in Canada. It was the Canadian regulators wanted to be harmonized with the United States, which was repealing an uptick rule, and there was a lot of studies done, and you can agree with them or not, that the uptick rule wasn't really benefiting the market. So the decision was taken to repeal it at that time. That was happening at the same time as multiple markets were coming into Canada, but they're not. The two aren't necessarily linked. So I just wanted to clarify that.
If there was a single trading platform, would the result be a first-come, first-served order book, and would that restore confidence in the junior markets?
I think multiple markets creates confusion, and people that have trade particularly I think in the venture market, are used to dealing with the great system that we have in Canada where they're very transparent markets. It's time, price, priority, and I think the Canadian market structure is as good or better than any in the world. So from that point of view, it would simplify things. People wouldn't, if they go to sell stock on a bid or buy stock on an offer, and by the time their order gets, routed to different marketplaces, sometimes that offer or bid are not there anymore, and they don't understand why they didn't get the fill that they would have got in years past. And that creates some discomfort in the marketplace. So from that point of view, I think a single market for venture stocks would help people feel more comfortable trading. Now, having said that, I think most people would say, well, of course TMX wants to have a single market to trade the venture stocks because, you just want to have your monopoly back. And I personally believe that that a single market for early stage stocks, like on the venture exchange, is best for the market. As you pointed out, we already have 90% of the trading. This is not about, us trying to go back to the good old days for the benefit of our market. It's for the benefit of the capital markets.
What could the TSX Venture Exchange offer clients and listed companies to eliminate the call for competing platforms in the future?
I'm not sure that we could really offer anything, Jim. It's a decision that was made that to open the markets up for competition by the securities regulators. I think it would be the securities regulators that would have to come to the conclusion that a single market was better off for everybody.
Should shorting be banned for all stocks under $3 or $5?
I personally don't think so. I think shorting is an important feature in a marketplace. It balances off overexuberance in a market. But as I said earlier, I think an uptick rule is an appropriate governor, if you will, to particularly for more volatile, less liquid stocks.
Some junior stocks from time to time are being hit with a board lot size sale on the downtick in the last half hour of trading. To combat this, is it possible to mark the tape with the last trade on the venture exchange, but not other platforms? And or could board lot sizes be increased for stocks under 10 cents and under 5 cents? And ultimately, would reinstatement of the uptick rule solve this?
Well, there's a couple of things in your question there. The first one about board lot sizes, I think that's quite an intriguing idea. And this came out of this idea came from a stakeholder, and while we were having the town hall discussions and when we were reaching out to get this kind of feedback from clients. And so this is one of the reasons I was really pleased that we did this reach out to stakeholders in the marketplace, because it started a lot of dialogue, and we literally received hundreds of great ideas, including this and sort of different variations of this idea. So we're looking at that board lot size and seeing, because that is something that is in our control, and seeing if it would help the market. So this is why it's so important to work with stakeholders.
Is it becoming easier for American investors to invest directly in Canadian markets?
Sadly, I think it's becoming more difficult. I've been in this business for a very long time, and I recall when it was just as easy for an American to trade in Canada as it is today for a Canadian to trade in the United States. Like if you or I go to buy shares on an American market, there's no issue. It's very simple. In my view, it should be just as simple for an American to trade in our markets. But for a lot of reasons, that's not the case.
What could be done to improve that?
We're looking at that. That's one of the tactics that we've identified in our white paper. We're working very closely with securities lawyers who do a lot of cross-border business, with dealers who do a lot of cross-border business. We're talking to the regulators here and in the United States, and trying to identify the issues that, we can, where maybe change is possible. I wish I could tell your listeners that I've found that smoking gun, and we're trying to address that, but unfortunately it's not that simple.
Hopefully the long and painful bear market in the resource stocks is turning bullish now. Some people have been calling companies with negative working capital zombie companies and calling for their removal from the venture exchange. Could these companies be kept on the venture exchange and charge zero fees by the exchange until they're in a positive capital position?
Well, if I want to, first of all, address your first point in that question, I am really pleased to see the trend in the marketplace right now. It's not appropriate for me as an exchange operator to be commenting on or giving investment advice or commenting on where the markets are going. But when you look at the venture exchange in the last few months, it's really been phenomenal. Our market is since the low on January 20th, the venture exchange index is up 40%. That's absolutely incredible. The venture exchange has outperformed every marketplace in the world year to date. Obviously, the index came off quite a bit from the highs, but the trend is looking very positive. And I'd say even what I'm even more excited about this week, we had the last 3 days we traded 300 million shares or more on the venture exchange. In 2015, the average trading volume was 130 million shares, which is still, very reasonably healthy for a junior market. But now, trading 300 million shares is fantastic, and I think that's such a positive trend. We haven't traded 300 million shares in a day since 2011, so I'm very excited about the trend in the venture market. With respect to the so-called zombie companies, well, first of all, that's not a term I would use. I would never think of our clients as that way. And I recognize there's some people who feel that we should be aggressively culling the market, but that is a minority view, and there's really no evidence to suggest that would benefit the market. And in fact, in reaching out to all of our stakeholders and getting a lot of feedback on this issue, there's absolutely no reason to make a change to where our continued listing standards are. And on a principled basis, I don't think it's fair to move goalposts on people. We've had the same continued listing standards which is the bar that we set when a company no longer meets the TSX Venture Exchange standards. If it drops below that, we move that company to a board we call NEX, which is a board that was created about a dozen years ago for companies that drop below the standard and give them a place to hopefully reactivate, whether that's raising capital, finding a new asset to develop, and then they can move back up to the venture market. Well, since NEX was created, over 300 companies have done exactly that. They've had been moved down to NEX, and they've now restructured, refinanced, and have moving back up to the venture market. So I'd say that model works exactly as it was contemplated when we created it. So I'm not contemplating moving that bar. We could, I think there's a good argument that we could make the continued listing standards bar more, simplify it, and we are looking at that. So Jim, I'm not sure that answers your question, but that's my current thinking.
Is it time to end the accredited investor program so that the little guy can invest in private placements that have warrants attached, with a caveat he signs risk disclosure acknowledging the placement he wants is high risk?
Well, I absolutely believe we should be continuously looking at prospectus exemptions or ways for everybody to participate in the venture exchange. Getting rid of the accredited investor exemption doesn't solve that problem. The accredited investor exemption is one tool to help companies access capital. We just need additional tools. Getting rid of one tool doesn't solve the problem. And probably most of your listeners know that in Canada, the basic concept when companies going to raise money is you can't issue shares from Treasury without a prospectus. That's the principle. And then there's something like 40 exemptions to that basic rule. The accredited investor exemption is one of those exemptions. But there are many others, and the good news is the securities commissions in Canada, I think, are becoming more and more open-minded to being creative and finding other ways. And this is something that's really important to us. We've lobbied very hard and worked with the commissions, and they've been very receptive to introducing exemptions like the existing shareholder exemption. Some provinces in Canada recently introduced what they're calling the dealer exemption. That idea came from some members of the TSX Venture Local Advisory Committee, and we're fully, very supportive of that. So, reviving updating the rights offering regime in Canada, which happened in December last year, is a huge change. So, I applaud the commissions for doing that, and we're already seeing more companies access capital via rights offering, which of course is a great tool because it gives all their existing shareholders the right to participate. So I think the short answer to your question is the accredited investor exemption is great. Let's find other tools for investors to access the capital and for companies to raise the money.
The junior capital markets in Canada need help from the regulators and exchanges. Independent investment houses focusing on the junior markets in Canada are disappearing from the landscape. Overregulation by regulators is being blamed. Is overregulation also hurting the TSX Venture Exchange?
Of all of the issues in the marketplace that I lose sleep over, the health of the dealers, particularly the independent dealers that have traditionally been great supporters of early stage public companies, that's probably the biggest issue. It's a disturbing trend. I'm hopeful that the increase in trading volume, the increase in share price, and will lead to more financing activity. In fact, we're already seeing that trend, and that will help the dealers. And I want to do everything I can to support them. But regulation for listed companies hasn't really changed much in many years. It's really about the availability of capital. So if the regulatory costs stay relatively constant, but companies have access to less capital, of course, just by pure math, that cost of capital as a percentage increases. What we have to do is get the availability of capital higher, but we have to also focus on the cost side of that equation too, and that's what we're doing. That's one of the three strategic priorities that we've got, and we've got a lot of ideas, and we're working on a lot of things to do that.
Are the regulators aware of structural problems, overregulation, and other issues plaguing the junior markets in Canada, and are they actively working on solutions?
Well, it's not my place to speak for the regulators. My experience is they're very aware of the issues. They care, and they'll want to do what they can to help. But at the same time, investor confidence is really important to them, as it is to us. The reason why Canada's public venture capital markets are as strong as they are, for many years, so we're not just talking about one cycle, is because investors have confidence in participating in early stage public companies. And that's not the case in many other places in the world. So we definitely don't want to risk that investor confidence.
If you were in charge of all junior markets in Canada for a day, what would you do to make Canada's junior markets the best in the world?
I thought I was in charge of the junior market in Canada. But the I would do exactly what we're doing. I would reach out to stakeholders and get many, many different views and from across the country and beyond as well. Last week I was I went over with 5 mining companies, and we met with 60 fund managers both in London and in Zurich, a total of 60 fund managers. And we spent literally hours chatting with them about all kinds of issues related to the market. So it's really important to get the feedback from the buy side perspective as well. Continue to get those ideas, identify things that where we can help, and which we have done, and then based on which we outlined in the white paper that was published in December. Then we went across Canada and talked to over 1,000 more stakeholders, shifted our tactics a little bit based on that feedback, and I think the issues that we've identified, or the tactics that we've identified, are the right ones that are going to help the marketplace. So what I would do is exactly what we're doing. And I think, based on the feedback we're getting, the vast majority of stakeholders feel that we're on the right track.
How important is the TSX Venture Exchange to the Canadian economy? I
think it's incredibly important. If you just look at one number, 630 companies have graduated from the TSX Venture Exchange to the Toronto Stock Exchange since TSX acquired Venture in 2002. And many of those have gone on to be, big companies in Canada. In fact, I think it's about 24% of the TSX Composite Index are made up of companies that have graduated from the junior market. So some of Canada's biggest and most liquid companies were incubated on this marketplace. And if you think about the thousands and thousands of people that those companies have employed as they grew their business, it's really important to Canada. You go in any community in Canada, and whether it's mining companies, oil and gas companies, technology companies, life science companies, many of them have had, got where they are because they've been able to access public venture capital. And you can't say that for many places around the world. This is about helping people with great ideas access capital so they can grow a company, add shareholder value, and create employment. It's to support entrepreneurs. That's what we do. That's what every stock exchange should do. TSX Venture Exchange is very focused on that.
John, if people had questions for the Venture Exchange, how can they get a hold of you?
604-643-6507. I'd love to talk to any clients.
John, thank you very much for being on This Week in Money.
My pleasure, Tim.
My guest has been John McCoach, president of the TSX Venture Exchange. That wraps up our show for this week. Thanks to our guest, John McCoach, and thank you for listening. This show can be heard online anytime on TalkDigitalNetwork.com or on the YouTube channel Talk Digital Network. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.